Clients sometimes ask me, does it make sense to pay a little bit more taxes now so that I don't leave a massive tax bill at death? And the frustrating answer is, well, it depends. Sometimes there isn't much you can do. You may already be in a higher tax bracket. The planning window may be too short, or withdrawing additional money today might create more tax without producing enough long-term benefit. But sometimes the opportunity is enormous. In the first example I'm going to show you today, paying more tax earlier reduced the client's projected lifetime tax bill by approximately $4 million. You heard that right, $4 million. That's why one of the most important numbers in retirement planning isn't just the tax bill for this year, it's your lifetime tax bill. Hey everyone, welcome back to the channel. I'm Martin Cloutier from Prestige Private Wealth Management. Most people think about taxes 1 year at a time. They look at their tax return this year, see how much they paid, and naturally they want that number to be as low as possible. That makes sense. Nobody enjoys paying taxes, just like no one likes hitting their hand with a hammer. But I'll tell you, low tax bills this year doesn't necessarily mean that you have a tax-efficient retirement plan. In some cases, paying less taxes today simply means you're building up a much larger problem for later. In other episodes, I've called this the tax time bomb. Delaying taxes and minimizing taxes aren't always the same thing. The first example we're going to cover today covers a married couple with a significant age difference. Gord is 70 and Marie's 49. That age difference creates an unusual planning opportunity because his registered assets could continue producing taxable income for many years to come. If those assets aren't managed properly, a substantial amount could eventually become taxable at death. On the screen, you can see two projected cash flow summaries. The table on the left represents the base plan without deliberate tax planning. The table on the right represents the recommended strategy. In 2026 and 2027, you'll note that the tax bills shown under the column heading taxes, they're the same. That's because of several factors that are specific to this particular plan that I won't get into. But beginning in 2028, however, the difference becomes much more noticeable. Under the recommended strategy, the annual tax bill is about $7,000 more per year in the base plan. At first glance, that might look like a bad result. Why would anyone voluntarily choose a strategy that causes them to pay more tax? Because looking at 1 year in isolation can be extremely misleading. Under the recommended plan, we're deliberately withdrawing more money from the husband's RRIF. We're bringing his taxable income closer to OAS coverage tax threshold without unnecessarily pushing him beyond it. In other words, we're making use of the available tax bracket while staying under the OAS clawback threshold, rather than allowing the registered assets to continue growing indefinitely. That additional money coming out of his RRIF isn't being spent. It's actually being redirected into the couple's TFSA. You can see that in the registered savings column in the recommended plan. They continue making TFSA contributions until the husband passes. Then the wife continues her TFSA. What's left of it after emergency expenses creep up and extra spending, they leave to their children. The result? Most of their remaining financial assets are held inside Marie's TFSA by the time of her passing, and that changes the tax picture dramatically. Under the base plan, the tax bill in the final year is approximately $2.7 million. That isn't the client's total lifetime tax bill, it's the projected taxes payable in that final year alone. To calculate the lifetime tax bill, we need to add every annual payment leading up to that point. When we do that, the base plan projects a total taxes of $5.3 million lifetime taxes. Under the recommended strategy, the final tax bill is roughly $27,000. We still have to include the taxes paid earlier in all the other years, but it's a lot lower under the recommended plan. When you add in all of those lifetime tax bills and every year it amounts to about $1.4 million. That's a reduction of $4 million compared to the plan where no RRSP or RRIF meltdown is considered. A large tax bill today can sometimes create a devastating bill later. That's the key lesson from this example. The goal isn't always to pay the least amount of tax this year. The goal is to control when the tax is paid, at what rate is paid, and how much is paid over the client's entire lifetime. Are you preserving a low tax bill today by creating a much larger tax problem later? Could earlier RRIF withdrawals help you to fund your TFSA, reduce future mandatory withdrawals, manage OAS clawback, or leave more money to your family? Those are the questions a proper retirement income plan should answer. But this doesn't mean that everyone should rush out and collapse their RRSP or RRIF. In some situations, accelerating withdrawals makes sense, and in others, it just doesn't. The strategy has to be tested against your income, your tax brackets, your spending needs, your age, your health, your estate objectives, investment structure, and the age difference between you and your spouse. The best strategy isn't always the one with the lowest tax bill today. It's the one that creates the strongest long-term result. Now, Before we get into the second example, if you're finding this video helpful, make sure to subscribe and hit the notification bell so that you'll know when new videos come out. And if you know someone who could benefit from this conversation, feel free to share it with them. Now, let me show you a very different type of tax planning problem. This client has what I call a perennial tax problem. She has two strong pension incomes, one from her own career and another as a survivor pension from her late spouse. She's also still working, and she has a significant amount of registered money that will eventually have to come out through her RRIF. Even if she stopped working, she'd still be in OAS clawback territory. Avoiding the clawback just isn't a realistic objective in this case. It's going to happen. There isn't a practical withdrawal strategy that suddenly brings her income below the threshold. Sometimes we need to recognize that a tax problem can't simply be solved through an RRSP meltdown. It doesn't mean that there's nothing we can do. It means that we need to look at the problem differently. That's where life insurance can become part of a broader tax and estate planning conversation. On the screen, you can see a current plan compared to the recommended plan. Under the current plan, the projected total asset value at age 90 is approximately $4.9 million. Under the recommended plan, which includes permanent life insurance, the projected estate value increases to approximately $6.1 million. That's an improvement of more than $1.2 million by age 90. Now, when most people think life insurance, they think about term insurance, the insurance they purchased when they had a mortgage or when their children were young. Insurance is the simplest form of life insurance, and it provides coverage for a specific period and generally protects against temporary financial need. You may need it while you have a mortgage, while your children depend on you, or while your family relies on your employment income. But estate planning involves a different kind of problem. Death isn't a question of if, it's a question of when. And when significant tax liability is expected to arise at death, permanent life insurance might be worth considering. Permanent life insurance can include an investment component that grows as the policy continues on a tax-advantaged basis. When the policy is properly structured, the death benefit can generally be paid to your beneficiaries tax-free. That can add significant value in the right circumstances. In this example, the client already has assets that she doesn't expect to be spending during her lifetime. That money is ultimately intended for her estate or her children, her loved ones, rather than leaving it in an account that might continue generating taxable income. We can consider repositioning a portion of those assets into a permanent life insurance policy. We're not creating money out of thin air here. We're reorganizing money that was already intended for the estate. And that's the real comparison. What does the client give up to fund this policy, and how much additional value could ultimately reach the family? And don't let gross net worth deceive you. What matters to your family is what remains after taxes and expenses. A client can have a very healthy looking balance sheet and still have a significant estate tax problem. The accounts may be worth millions, but how much of that value will actually reach your intended beneficiaries? That's why knowing your lifetime tax number really involves two numbers. The first is how much tax you're projected to pay throughout retirement year by year. The second is the liability expected at death of the last surviving spouse. Sometimes we can reduce those taxes through earlier RRSP or RRIF withdrawals, TFSA funding, and income splitting, and better, of course, withdrawal sequencing. Sometimes the tax is difficult to avoid, but we can use insurance to provide tax-efficient liquidity and improve estate outcomes. Reduce the tax where you can. Plan for the tax when you can't. Of course, life insurance isn't appropriate for everyone. The client has to qualify medically and financially, the premiums have to be sustainable, and the policy has to be compared against other alternatives. The strategy should never compromise their client's lifestyle, liquidity, flexibility, and retirement security. And even if you feel you've waited too long to begin this kind of planning, don't beat yourself up. The strategies available may be different now, but that doesn't mean that the planning opportunity has disappeared. Sometimes good planning means changing when tax is paid. Sometimes it means changing which assets will pay it. And sometimes it means reorganizing assets so that more of your money reaches the people you intend it to. And if you'd like help understanding your own lifetime tax bill and whether there are opportunities to improve your retirement or estate plan, feel free to book a coffee call using the link below. Our role is to simplify complexity and help you to make better decisions. And that's how we're helping you live for today while planning for a better tomorrow.